Happy Monday, everybody. Welcome to the weekly economic update for June 13th, 2022. Hope everybody had a fantastic weekend out there. It's been pretty warm here in Colorado, especially since we don't have air conditioning. So it's nice and cool here down in my office in the lower level. But upstairs, it's like 86 degrees. And I just went up and took a shower. So if my face is all red, I apologize that I look like a cherry right now. Alrighty. Well, if it's your first time watching, please give me a subscribe, a like, a share, all that good stuff, depending upon what platform you're on. And let's go ahead and dive into the markets. It is an ugly day. As you can see, nothing but red. We only have one exchange that was in the positive and looks pretty ugly. So let's go ahead and start out with the Dow Jones. It finished down 2.79% at 3516. The S&P 500 finished down 3.88% at 3749. NASDAQ was down 4.68, closed at 10,809. Small caps are also down more than 4.75%. The VIX was up 22.59% today. It's currently sitting at 34. Moving on to the other exchanges here in the Americas, Canada was down 2.63, Brazil down 2.73, Mexico basically flat, finished down 0.05%. Moving on over to Europe, Germany down 2.43, UK down 1.53, France down 2.67, the Euro stocks down 2.69, Netherlands down 3, Spain down 2.47, Italy down 2.79, Switzerland down 1.7, Portugal down 1.18. Let's go ahead and move down to Russia. See, they were kind of split. The MOEX down 0.37, while the RTSI was up 4.64%. The one bright spot in most of the markets across the world. Let's move on down to Asia. Japan finished down 3.01% today. Australia down 1.25%. New Zealand down 1.76%. China in the Shanghai market was down 0.89. The SESE component down 0.3. The China A50 down 2.14. The DJ Shanghai down 0.98. Hang Seng finished down 3.39. And the Taiwan weighted came in down 2.36. So like I said, ugly, ugly day. It's ugly as a redheaded stepchild out there. So, all righty. Well, let's go ahead and look at this week's weekly economic update and see what's in the news. Week on Wall Street. A higher than expected inflation report triggered off a sell-off on Friday, leaving stocks in the red for the week. The Dow Jones lost 4.58%, while the S&P 500 was down 5.05%. NASDAQ slid 5.6%, and internationals declined 1.81%. Inflation up in stocks. Stocks gyrated between gains and losses last week until sliding lower on Friday's hot inflation report, which heightened worries over a more aggressive Fed and further economic slowdown. Stocks moved higher to begin the week despite rising bond yields, a profit warning from a major retailer, and Senate testimony by Secretary of Treasury Janet Yellen, who said inflation was likely to remain elevated. Well, that's probably the first time Janet has been right about anything. I mean, if you recall a year ago, she was saying, it's transitory. It's nothing to worry about. Yeah, well, someone was saying this was a big deal. This guy right here. And, unfortunately, nobody listens to me. Well, except for my clients, but there's not enough of them to really make a difference in the big picture of things. Let's see. Stocks turned lower in the week on renewed concerns of an economic slowdown sparked by a downward revision in the Federal Reserve's Atlanta's real-time estimate of second quarter GDP growth and a drop in new mortgage applications. Investors lightened up on stocks ahead of Friday's inflation report, may have also contributed to Thursday's selling. Inside inflation, consumer prices rose 8.6% year over year in May, marking the highest rate since December of 1981. That was a good year. I was in second grade. Price increases over the last 12 months were driven by a 34.6% jump in energy prices and by fuel costs, which climbed 10.1%. Used car and truck prices, which had seen 3 straight months of declines, rose 1.8% from April, while airfare soared 12.6% in May. Whew. May's inflation exceeded economists' forecast and dashed the hopes that inflation had plateaued. Remember all those people saying that, yeah, inflation has peaked. The Fed could probably by September just, take a break and not worry about it. Well, we know the truth. In a separate economic report on Friday, real wages net of inflation fell 0.6% in April and were lower by 3% from 12 months ago. All right, economic data coming out this week. Tomorrow we have the producer price index, which is the basically like the inflation report for companies buying products to turn into something else. Wednesday is retail sales and the FOMC announcement. Thursday, jobless claims and housing starts. Friday, industrial production and the index of leading economic indicators. And we only got 2 companies reporting earnings this week. On Thursday, we have Adobe and Kroger. Hey, Kroger, my first place I ever had a job at. All righty. Let's see. Next article here, or white paper I have going out to those on my email mailing list, is the monthly economic update. We'll just breeze through some of the highlights here. Let's see. For the month of May, the Dow Jones picked up only 0.04%, while the S&P 500 added 0.01%, and the NASDAQ fell 2.05% for the month. Let's see. It's all about the Fed. The month began on a solid note as stocks rallied following the Fed's announcement of a 50 basis point hike of the federal funds rate. The market was relieved to hear the comments from the Fed Chair Jerome Powell, who said that a 75 basis increase was not actively being considered. Well, not till now. This rally lost momentum as investors reassessed the Fed's commitment to a tighter monetary policy and digested some economic news that fanned inflation fears. Let's see. Was there anything else that really jumped out? The sector scorecard. Let's see how industry sectors that managed to post gains in May included the communications sector, which was up 1.9%, energy up 16.03%, financials up 2 3/4%, healthcare up 1.5%, materials up 1.18%, and utilities up 4.31%. The remaining sectors moved lower, with losses in consumer discretionary down 5.12%, consumer staples 4.08%, industrials down 0.46%, real estate lost 5.11%, and technology down 0.69%. All righty, so I'll go ahead and skip the rest. There's a lot of stuff there. You could read it at your own leisure. It is available at dsafinancialgroup.com, or you can email me, and here's my email address right here on the front of the screen. You can email me, and I'll be happy to add you to my list. All right. Let's go ahead and read through today's market recap. S&P 500 slips on Rout in growth stocks after bond yields surge on Fed hike bets. The S&P 500 fell into bear market territory on Monday following a sea of red in growth stocks as Treasury yields surged on bets that the Federal Reserve is set to lean more hawkish to tackle inflation. Let's hope. Let's hope they got Dick Butkus tackling people. Or Mike Singletary, another of my favorite all-time linebackers. The 10-year Treasury yield climbed to its highest level since 2011 on concerns that the Fed would be forced to step up the monetary policy tightening accelerator following the upside surprise in Friday's inflation data. Again, who's surprised by this? Growth sectors of the market, including consumer discretionary and tech, were the biggest drag on the broader market. Tesla fell by more than 6% to lead the decline in consumer discretionary amid worries about the impact of the potential lockdown measures in Beijing following a spike in COVID-19 cases. Man, those people just cannot catch a break. Big tech was led lower by Amazon and Meta Platforms, each down more than 5%, as bets on rising rates dent investor appetite for stocks with higher valuations. The U.S. Central Bank is expected to raise its benchmark rate by 0.5% this week, but could signal a willingness to do more following recent data showing price pressures continue to run hot. Quote, the FOMC is likely to respond to the firmer inflation print and the rise in long-term inflation expectations with a resolutely hawkish message at the June meeting. In addition to the 50 basis point hike it is set to deliver, end quote, Goldman Sachs said in a note. Against the backdrop for a more aggressive Fed, expectations are growing that the central bank could slow the economy into recession, leading to a weaker consumer that would hurt demand for travel and leisure. Caesars Entertainment, American Airlines, Norwegian Cruise Lines, and Booking Holdings were down sharply. Meanwhile, energy struggled to cut losses even as oil prices turned positive, despite concerns that rising COVID-19 cases in China could slow energy demand. Pioneer Natural Resources, Phillips 66, and ConocoPhillips were among the biggest decliners in the sector. Cryptocurrency-related stocks were deeply in the red following a rout in cryptocurrencies triggered by crypto lending company Celsius Network freezing withdrawals and transfers. MicroStrategy, Block, and Coinbase Global were down double digits. So, ugly as redheaded stepchild. It's only probably going to get worse. So, I remember back in 08, 09, it was pretty stressful for people in my position. I actually, the stress got to me a little, I tried to put up a brave face for all my clients at the time, but, I actually had a spot of hair right here. My beard completely fell out. I had to, if you look on my website, the picture I use there is a clean shaven version of me. And that was during that time that for about a year, there was just this right here around my chin. So I just shaved it all off and eventually grew back. But stress is a bitch. So today, after, more than a decade of doing this, really nothing really works. I mean, I get worried, but, there's really not much you can do other than try to position yourself before the problem as opposed to waiting until things fall apart. All right. Next article I got here is rising expectations of aggressive Fed move this week, roil markets. Rising expectations that the Federal Reserve will raise interest rates by more than previously forecast unsettled investors on Monday, fueling steep declines in U.S. stocks and bonds and intensifying fears over the economic outlook. The Federal Reserve meets on Wednesday following data last week showing that U.S. consumer prices rose at their fastest pace since 1981. CME's FedWatch tool, based on the prices of short-term credit futures, shows a 30% chance of a 75 basis rate hike at this month's meeting. Got some more on that. Up from a 3.1% chance seen 1 week ago. A 75 basis point hike would be the biggest since 1994. Quote, the May inflation data was so concerning that we think the Fed will react even more aggressively and moving rates expeditiously, BNY Mellon strategist John Velez said on Monday. His note forecasts a 75 basis point hike up from 50 basis point prediction. Barclays and Jefferies also forecast a 75 basis point hike. Quote, U.S. CPI surprised to the upside and continues to show broad and persistent price pressures, Barclays analyst said in a note on Sunday. Quote, we think the Fed probably wants to surprise markets to reestablish its inflation-fighting credentials, end quote. The S&P 500 appeared on track to confirm a bear market on Monday, while a widely watched part of the Treasury yield curve inverted on fears that big Fed hikes would tip the economy into recession. Yields of benchmark 10-year Treasuries, meanwhile, hit their highest level since 2011. Quote, the markets are not waiting for Wednesday's Fed meeting. They're going to front run them, and that's what's already happening in the markets today, said Jim Paulson, chief investment strategist at Leithold Group. Other large investors on Wall Street said they do not see a 75 basis point move as imminent. The probability of such a large rate hike in the next few months are rising. Standard Chartered said that even a 100 basis point hike could not be precluded. In session, markets reacted with a sell-off in short-dated treasuries along with futures tied to Fed policy rate. Yields on 2-year treasury notes are at their highest since late 2007. Bets on U.S. terminal rate, where the Fed funds rate may peak this cycle, continue to rise. On Monday, rates were priced to approach 4% by mid-2023, up almost 1% since end of May. Deutsche Bank said it now saw rates peaking at 4.125 in mid-2023, so basically a year from now. In one signal of turmoil in the global fixed income market, credit default swap indexes measuring the cost of insuring against European corporate bond defaults jumped on Monday to their highest since 2020. U.S. corporate bonds were also pummeled over the economic outlook and companies' ability to repay their debt. For Rabobank, the risk of stagflation, a period of weak growth and high inflation last seen in the 1970s, could give way to a threat of incession, a combination of inflation and recession. It said in a note on Sunday. The shape of the Treasury yield curve inversion, raising high yield credit spreads and underperformance of cyclical stock market sectors indicated rising concerns on economic outlook, said Oliver Allen, an economist at Capital Economics. Quote, one interpretation is that investors are veering towards a view that the Fed will need to induce a recession if it is to bring inflation back to target, he said in a note. So yeah, what the Fed, basically Fed Watch, 2022 is what's going on right now. Is what's the Fed going to do? Are they going to stick with their plan and just do 50 basis points? Are they going to go up to 3/4 of a point or 0.75%, or go as high as 1%? Personally, I'd like to see them take it up to 5% today. Yeah, it's going to be a huge shock. But, anything to cool things down would probably be a good bet right now. All right. More on what the Fed's going to do from our friends at First Trust. Brian Westbury is the author of this article, 50 or more. All eyes will be on the results of the Federal Reserve meeting on Wednesday when it announces how much it's going to raise short-term rates in its new projections for the economy and short-term rates for the next few years, as well as Chairman Powell's press conference. After the last meeting in May, Powell made it very clear that the Fed anticipated raising rates by 0.5 percentage point at each of the next two meetings, this week's event and in July. When asked about larger rate hike, Powell was dismissive. Let's see what he says this week. But after Friday's news that consumer prices rose 1% in May and are up 8.6% versus a year ago, the most in more than 40 years, the futures market in federal funds is pricing in moves at least 50 basis points this week and into July. A widely known investment TV celebrity said the Fed should go 100 basis points all at once on Wednesday. We would fully support a 100 basis point rate hike this week or even more. In fact, we were calling for an even sharper rate hike and faster pace of quantitative tightening back in March before it was cool to act tough. Yeah, I think I was even ahead of you, Brian. We would not be shocked if the Fed raised rates by more than 50 basis points on Wednesday, but we think it will more likely stick with the 50 basis points only. Why? Remember that Powell was emphatic back in May when the Fed did not need to go 75 basis points at the next meeting. Moreover, Powell puts a great deal of weight, way too much in our view, on gradualism and signaling rather than just focusing on getting monetary policy where it needs to be to achieve the goal of getting inflation under control. To Powell, if the Fed ends up raising rates by 75 basis points or more this week, it'd mean he wouldn't be able to accurately signal the pace of future rate hikes the way he wants. Again, we don't think that should matter nearly as much as getting monetary policy right, but we think signaling ability is more important to him. Yeah, well, it's like a lot of people in government, and I throw the Fed into that same category. I mean, I know they're privately owned, but they basically are in cahoots with the Treasury and our government. And more often than not, they just want to look good and keep their jobs. They're less worried about doing the right thing at the right time. But again, maybe that's why I don't work for the Fed. Instead of getting 75 basis points or more on Wednesday, pay close attention to what Powell says about the size of the likely rate hike in July and the months beyond. We anticipate he will show more openness to larger rate hikes this week than he did back in May. Given the stubbornly high path of inflation, he probably regrets being more dismissive about the rate hike of 75 basis points or more back in May. Either way, we think the market needs to focus not only what happens on Wednesday, but what happens on June 28th. That's the day at noon Central Time the Fed releases its monthly figures of measures of money supply. In the current economic environment, that news should be at least as important as what the Fed does with interest rates. The Fed used to implement monetary policy by using open market operations to add or drain reserves from bank systems, thereby controlling interest rates. That all ended around the time of the financial crisis in 2008. Now the Fed adjusts short-term rates directly, but we believe it's the growth of the M2 measure of the money supply that determines the pace of inflation, and no one knows how effective under the new post-2008 regime, raising rates will be to keep M2 growth in check, enough to bring down inflation. Only time will tell. Either way, we anticipate lots more rate hikes and quantitative tightening before the Fed wrestles inflation back down to its 2% goal. I agree with most of what Brian says. I mean, he's usually pretty tough, and he's a little more mild in his views on things. I'm more of a slash and burn kind of person. I'd rather, get it fixed now than, pussyfoot around and, try to make everyone feel good. And we're really going to raise interest rates. I mean, they started that talk back in October or November last year before they really even start, what was it, March when they first did something, they only did 0.25%. All right. One last article here. It's also got a video attached if you want to read through it. Comes from Zero Hedge. Erian, inflation could have been avoided if the Fed had acted earlier. I 100% agree with that. My nose is itchy. All right. Allianz chief and economic advisor Mohamed Erian said in an interview that current inflation problem in the United States could have largely been avoided if the Federal Reserve had acted earlier. Quote, the problem for us is that they're far away from the first best response. Erian told CBS's Face the Nation yesterday, quote, this is going to have enormous economic, social, it hits the poor particularly hard, institutional and political consequences, and most of all, it could have been avoided had early actions been taken, he added. Quote, the lesson of history is once you fall behind, he said, you end up in this awful situation where you're in today, where you need to make a choice. Do you slam on the brakes hard to control inflation or risk recession? Or do you just tap the brakes and risk inflation lasting much longer than it should, end quote. He spoke as the U.S. annual inflation report inflation rate surged to 8.6% in May, topping the market estimate of 8.3% according to official data. Being one of the largest contributors to the spike, the average gas price nationwide also hit $5 a gallon for the first time in history on June 11th. The American Automobile Association recorded as the average topped $6.43 in some states such as California. Despite the central bank's current tightened monetary policy to fight inflation by implementing a series of rate hikes, Erian said long-term inflation expectations are now standing at 15-year high of 3.3%. Quote, we got here because we got a combination of things happening. The Economist said during his Sunday appearance, citing external factors including the Ukraine war, energy transition, as well as the Federal Reserve's misjudgment and delay in acting. President Joe Biden said earlier this month that he wouldn't be able to bring down gas and food prices in the short term, citing the war in Ukraine has trapped the country's wheat exports as an external cause for inflation. Okay. The administration has been playing down the risk of recession over the past year and dismissed taking responsibility for policy-driven inflationary pressures. The president's top economic advisor suggested last month that Americans be confident during what he called a, quote, period of transition of COVID-19 recovery. Quote, humility is totally called for, Erian said. Quote, I was very puzzled when a year ago so many people were so confident that inflation was transitory. There was so much we didn't understand about the post-COVID inflation. End quote. The current stagflation with low growth and high inflation would lead to a recession, he said, continuing with the most optimistic outlook of the Fed's regaining control and a, quote, soft landing of the economy without tanking the economy. A spokesperson for the U.S. Federal Reserve did not immediately respond to requests for comment. The Fed's Vice Chair Lael Brainerd said on June 2nd that September would see another big rate increase if inflation did not moderate. And there's the video right here. It's about 7 or 8 minutes. You can listen to Mr. Erian. And I think he's the head economist at Allianz Financial. So smart guy. And I agree. We should have done more 2 years ago, quite honestly. I mean, we could have nipped this in the bud if we didn't print all those stimmy checks, which, I know it helped out some people, but I think most of it got looted by the pirate class in government. They handed it out to all their buddies. And, hey, we got money here and there. So let's go ahead and, increase the money supply by 39, 40%. What could go wrong? Well, now we're seeing it. So, all right. Well, that's everything I had for today. If anybody needs anything from me, please go to dsafinancialgroup.com. All my information's there. You see my buddy Jake back here taking a nap. He doesn't seem very excited because he's the door shut. But anyways, like I said, if you need anything from me, go to dsafinancialgroup.com. All my contact information's there. And I'll be back tomorrow with the Liberty Call. So everybody have a great night. Bye-bye.